Hi. I am Ehsan Hosseini, a lecturer and trader in financial markets. In this video I want to talk about moving averages. In some tutorials you have been told that you can buy and sell with two short-term moving average and a long-term moving average crossovers. For example, you buy in this crossover and you sell here with 90% profit or this. What they don't tell you is that these results happen maybe 10% to 15% of trading days, if you're lucky. Actually, a normal day of trading is like this. There is no profit and almost all signals end in a loss. If you use the crossover pattern without considering a series of tips, your account will be called after 2 weeks. I will definitely talk about the best way to use moving averages in the following. Before we continue, if you are new to our channel, make sure you subscribe, click the notifications bell and leave a like to show your support. Now, why are moving average crossovers so popular? Because, a moving average is a trend indicator, and you were told that the trend is your friend, so why not using 2 or 3 moving averages, to increase your chances? 2-3. The first point. Moving averages crossovers don't work on lower time frames. You have a hard time trading crossovers on the 5-minute or 15 minutes charts. But at higher times it can benefit us. But first, let me explain why it's dangerous for you to trade crossovers on lower time frames and why this strategy will most likely lead to frustrations and bad results. The biggest drawbacks of moving averages is the fact they price lag. Price moves first and the moving average moves second. You are always behind the price. The moving average is a trend following indicator. It can only tell you when the trend has already happened. You can't forecast a new trend with a moving average because it's a lagging indicator. Pay attention in this chart that the moving average was still rising whilst price hit the resistance level and went down by a considerable amount. The second point. Another drawback of a moving average crossover system is the sideways markets or trading range. Nothing is more frustrating than trying to use a crossover strategy in a sideways market. Regardless of what type of moving average you use in a sideways market, they will not work effectively. So, if you are a day trader, I would say it's better to avoid crossover strategies on lower time frames. The third point. There are better ways to use a moving average. Moving averages are great to determine the trend direction of your instrument. While price action and structure should be your main focus, you can get a general idea of the market direction with a moving average. Upsloping is an uptrend and downsloping is downtrend. You can also use price location. If price above moving average, look for long trades. And below the average you would look for short opportunities. A coin is considered to be in an uptrend when the price is above a moving average and the slope is upward. A coin is considered to be in a downtrend when the price is below a moving average and the slope is downward. The second way you could use a moving average is as support and resistance level. Moving averages offer traders dynamic areas of support and resistance because are changing depending on recent price action. Moving averages offer traders dynamic areas of support and resistance because are changing depending on recent price action. A longer-term moving average like MA200 has a greater relevance to the price, and offers less false signals, compared to shorter-term moving averages. The question is, are moving average crossovers useless? Well, not quite. On higher time frames, for traders and investors that hold positions for several months using higher time frames like daily, weekly, or even monthly charts, the moving averages have higher chances of indicating a valid signal. In this model, you have to consider a long-term trend and ignore the small things that happen between the trends. And here another important tip which will cut your losses even more. When a buy signal is generated, you must wait for the bar to be completely finished before entering the trade. I can't remember how many times I traded a crossover signal without waiting for the candle to be closed. So, wait for the candle to close and confirm the crossover, it will save you a lot of bad entries. Once you have triggered your entry, there are several ways to manage this trade. Traditionally, you would remain in the trade until an opposite signal appears. While waiting for an opposite signal to exit your position may be the normal approach, you may find this method to be inconsistent, depending on the market's behavior. This approach will often lead to extremely late exits, which can severely cut into your profits. Instead, you could try other tactics like using a traditional trailing stop, using a single moving average crossover exit, using a fixed profit target, using Fibonacci extensions as targets, or using visual support and resistance levels as targets. Until next time.